Investors have reduced their short positions on the pound from a two-year high for the first time since the beginning of June. That's according to the latest CFTC data. Sterling rallied by more than 1% against the greenback last week after 4 weeks of declines. Meanwhile, UK Prime Minister Boris Johnson gets set to meet the French President Emmanuel Macron in Paris on Thursday to discuss Brexit. Joining me to discuss the outlook for UK assets is Paul Sedgwick from Frank Investments. Paul, good to see you. Well, let's start with the pound then, because it's really been in free fall ever since those highs around, all the way back in March, essentially. We've had a little bit of a pickup in August, but nonetheless, sentiment really seems to be on the downside. I wanted to get your outlook for the pound as we head into that 31st of October deadline.
Well, obviously the 31st of October deadline will have quite an influence on the pound. The pound, is, as we all know, is trading back to the lows it was at when Brexit was announced, when the result of the vote was announced. And you've also had some weak second quarter economic growth. You had that negative earnings growth of the last quarter. So that's all impacted sentiment towards the pound. Looking forward, we could well see a slightly better economy in the third quarter. Some of the recent economic data that's come out has been a little bit more positive. You may get, obviously, the other thing to think about is that the dollar itself has been quite strong into the start of this year, or for the large part of this year. That's also had a negative impact on sterling. So it's possible that maybe the dollar starts to weaken a little bit if the Fed gets slightly more dovish. Sentiment towards the UK improves a little bit, possibly if people see Macron and Johnson talking. Sentiment towards the possibility of a no-deal Brexit has obviously gone up, but if that starts to recede again, you could actually see the pound recover a little bit from here. So I think it's very hard to get overly bearish on the pound here, but obviously there's still a lot of uncertainties out there.
What about the UK equity market? Of course, we know there's that inverse correlation between the FTSE and the pound, and that's why we've been seeing the UK index perform pretty strongly this year. I mean, we're up around 7,204 roughly at the moment. I mean, we had that pullback in August, as you can see on the chart, but nonetheless, the overall sort of shape of this chart is a positive one, at least in this year. I mean, again, as we head towards that key Brexit deadline, I mean, do you expect to see further upside?
Well, it's an interesting point you made there. I mean, actually, the FTSE is up this year, but it's been more dragged up, I think, by the fact that global indexes and generally have been a little bit better. I mean, you'd actually think with the weakness of sterling, you'd have expected the FTSE possibly to perform even better than it has done. I mean, optically, the FTSE looks pretty attractive to me. I mean, you've got it talking about an earnings yield of about 7%. You've got UK gilt yields below 1% for 10-year. So the risk premium for equities is pretty high. So I think it's optically UK equities look pretty attractive, and you've got a list of stocks which you can pick. You can put a pretty attractive portfolio together of UK blue chip companies with dividend yields above 5%. I mean, you look at Imperial Tobacco, nearly 10%. You saw the house builder results today where they've announced the dividends. You've got the mining companies, you've got the oil companies, you've got the insurance companies, all offering very strong dividend yields, assuming there's all those dividends are sustainable. So you can paint quite an attractive picture at the moment for UK assets. What is obviously hanging over them is the uncertainty about what will happen with Brexit, the fact that UK growth in general is particularly weak, and so people are sort of keeping away from it. But if you look at the fund manager surveys, people are generally underweight. UK equities fund managers are generally underweight. So these periods of time can create opportunities. So obviously you have to be brave to sort of to sit there and take advantage, or think about taking advantage of these opportunities.
So in terms of sector opportunities, are there any sort of sectors that you're looking to in particular? I mean, the housing market was one you mentioned just before. We had those results from Persimmon, that very attractive dividend that came out, a record, I believe. But not least that, we also had some data from Rightmove that really surprised on the upside. It looks like sales are doing pretty well, as a lot of the people within the market try and lock down an opportunity as we head into that possibility of a no deal.
Well, I mean, you've got relatively low unemployment. You've got a supportive monetary policy in terms of being able to enter the housing market. So that sector does look to me looks reasonably attractive. I think the question for investors is, at the moment, you've obviously got the domestic UK stocks, those really exposed to the UK economy. So, as we said earlier, you're talking about the house builders, you're talking about the bank shares, you're talking about the utility companies. Utilities actually held up better than most, but certainly the UK bank sector has been under a great deal of pressure. The house builders have been very weak this year. I think these sort of things, you've got to look at this sort of thing, and if you feel that there's some hope for the UK economy to pick up, and if sentiment did improve towards some form of negotiated deal with Europe, then you could see a recovery in the more domestic related sectors.
So what have you made of the recent economic data in the UK then? Because, I mean, there have been certain sort of parts of patchiness, particularly when we think about the inflation story. Given the fact that the pound has come down, there is that risk of import price inflation. I mean, the growth story also looks a little bit weaker. Is that just the top line headlines, or as you get a little bit more granular, does that also reflect possible weakness ahead?
Well, obviously, we've had some better data in the last few days, some decent retail sales data, so we've had a little bit of... So it does look like you're going to get a pickup in the third quarter. Obviously, we had that slightly stronger than expected first quarter, and people put that down to some stocking up ahead of the Brexit. Then that was reflected as it weakened in the second quarter, and we may get a little bit of a pickup in the third quarter. It's obvious that you hear businessmen talking about while there is this lack of clarity of what is going to happen and how they should be preparing for Brexit, there's a lot on hold at the moment. But there are a lot of companies in the UK that are exposed to the global economy, and if the global economy does start to improve because of the stimulus that's put through, you could see that the UK gets a benefit from that as well.
And what about monetary policy as we head towards the end of the year? I mean, the jury's out as to whether we're likely to see a cut or a hike from the Bank of England next, because it's really in a bind in terms of if we do have that uncertainty around Brexit, it may want to stimulate the economy with lower rates, but obviously there is the risk of inflation as well, and that would warrant a rate rise. Well,
of course, the big question is, do we get stagflation? Do we get stagnant growth and inflation? And that is the worst scenario for a central bank, because obviously they don't want to put interest rates up if inflation is starting to pick up. But if the weak pound does put some inflationary pressures into the UK economy, and then you've obviously seen some wage growth recently with lower unemployment. So it is a difficult position. I mean, the world is at the moment tending towards keeping interest rates supportive for global expansion. I think for us to fly in the face of that and start to put interest rates up would be surprising. I think the likelihood is they'll probably stay where they are. All right, Paul, thank you very much. Pleasure. That was Paul Sedgwick from Frank Investments talking us through how to invest in the UK right now. I'm Victoria Scholar, and thank you for watching IGTV.